Real estate investment practice problem using Excel. Decision to purchase a home or rent calculation, new format, part number 3. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 4 tabs on down below: example, practice, blank, and then we made our pivot table tab. Let's take a look at them now, starting with the example tab, in essence being an answer key. In prior presentations, we took a look at the data on the left-hand side, which once set up, we can then change for multiple different scenarios, which should change the rest of our calculations if set up properly. We created the pivot table. We created our amortization table, then the pivot table, and then we constructed our loan summary in years with the years on the rows instead of the column, and then we looked at our property value. Now we're going to use this information to do our cash flow calculations. Once having it, then we can then go to our time value of money analysis. So we're then going to go to the practice tab. Some of this information already set up in terms of the formatting, so you can work through this practice problem a little bit faster with the formatting set up for you here. We got the blank tab. That's where we're going to be building this thing and have been building it from scratch. So we once again have the amortization table, the pivot table. We have then entered our data once again over here that ties to the prior data field, so it'll then change automatically as we change the first data field. And now we're looking at our loan summary, which we broke out by year, but not like the pivot table with the columns up top, or our traditional pivot table. We have another pivot table on this tab that looks similar to this calculation here, but we did it with formulas, and then we calculated the property value. Now we're going to look at the cash flow. So let's do the next one. It's going to be cash flow for home purchase before taxes. So the home purchase scenario is always going to be obviously going to be the more difficult of the two with regards to rent versus the home purchase. Remember, we're considering from the standpoint of we are currently renting, and we're thinking what would be the cash flow differences if we put the investment in essence, the home. So we're concentrating now on the cash flows related to the home purchase, those being more complicated. Note that this nice header we have up top, one of the benefits of having this format in the rows versus the columns. Going to format this up top, font group, making this that dark blue and white, as has been our custom. We're going to put the years up top. So we're going to add the years again, which is going to be 0, tab, 1, tab, 2, tab. Selecting those 3 tabs, bringing that on out to 30 years. This is kind of the downside of this format because the years are up top out to 30, which is kind of a long ways. We're going to then bring this up to the black and white up top. Let's center it to alignment. Let's center that too. There we go. Looking nice. Then we're going to go black and white down here too. There we have it. So the cash flow, if we were to purchase the home for home purchase, would then be, we'd have the property taxes, we got to spend. Obviously, we'd have the loan payment. We'll do that last. But the property taxes are based on the value of the home. So we're going to say the last year's valuation of the home is what we're going to use to calculate the property taxes, remembering this may differ depending on the state and local area you're in that's charging you the property taxes in terms of how they will charge, but they have an incentive as market prices go up to try to appraise your home higher so they can charge you more money. So we're going to assume that that is the case here. We're going to say this is going to be equal year 0 times the property tax rate, which is going to be that 1.5%. That could differ depending on your state and locale. I'm going to make that one because it's in column R outside of our table. Absolute F4 keyboard, $ before the R and the 11 and enter. And then we'll simply copy that one across. It will then be increasing as the property value increases all the way out to year 30. We got that increase in the property taxes, but those might be deductible, but they're limited to the deductions possibly. So then we have the interest payments. We have the interest. Let's go insurance. Insurance, not the interest. We'll talk about the interest with taxes later. Insurance, we're saying it's going to start off at that 700, and then we're going to say that it's going to increase by the amount of inflation, which we said is basically 2%. So we think that expenses are going to increase in essence 2%. So I'm going to say the last one 700 times. I'm going to bracket this 1 plus the 2% growth rate for interest in essence, closing that up. We also need to make that R formula or that R reference absolute. We only need a mixed reference, by the way, but absolute will work. So I'm going to make it absolute because it's easier. F4 keyboard, $R, $8, and enter. Copying that across, we'll have that increase of the 2% increase all the way out to year 30. Then let's do the same thing for the other. We had maintenance, which started out at the $800. It too increasing 2% a year, equaling the prior year, times brackets 1 plus the 2% increase. We're pulling from our data set so we could change that if we want to in different scenarios in the future. F4 on the keyboard, making it absolute. $R, $8, because we don't want that 2% to move as we copy it across because it's not in our table. Closing it up, enter, put our cursor back on, drag it on over to 30 years. We got that increasing. And then we got the payment amount, the loan payment amount that we're going to have to pay. Loan payment. And it's actually going to be fixed because we fixed the interest rate. So we're going to have the payment be the same. Now, this is interesting because we locked that in. We know that if we were to rent, we're going to assume the rent is going to continue to go up at, we're going to say 2%, whereas the payments will remain the same. So we'll actually have this difference in the cash flow. These items up top are going to increase with inflation, but the big guy, the big one, the loan payment is going to stay the same. Whereas when we compare that to the cash flow related to the rent will be increasing by that inflation 2%. So the payment was at this, what did we say, 25,540, which is the 2001 2897 times 12. And we're just going to keep that the same. Therefore, F4 on the keyboard, absolute reference, $R, $20. And then put our cursor back on that, copy that on across. Copy it on down to 30 years. There we have same payment for the big one. And then let's total that up. Total cash flow, which is using the trusty sum function, SUM, of those four numbers. And then we'll just copy that across. Let's underline, well, let's copy it across. Let's not get crazy trying to do multiple things at one time. So there we have that. And then let's put an underline on this one up top. Put an underline up here for formatting's sake. There's the font group. Let's underline it for font's sake. All right. So there we have that. So there's the cash flow. Let's make that blue and bordered. Make it look all standard and nice. So we're going to go font group, border it, bucket, bluetized. There we go. So now we're going to think about the tax consequences because some of those payments are going to have tax consequences and tax benefits. So let's think about the cash flow related to taxes now. So cash flow, home purchase for tax savings. So notice we can put a nice long header, which hopefully gives us some idea of what we're doing here a little bit more easily possibly than we could when we did the column formatting. We're going to go up top and we'll say, let's make that the dark blue and the white as has been our custom. Years are going to be equal to 1, 2, or 0, 1, 2, tab. Selecting those, bringing it on out to 30 again. 30 years. Formatting that with the black and white, centering on the alignment. There it is. Black and white on the years as well. So the deductible items could be the property taxes typically, because state taxes might be deductible, and the interest. But we're going to put a cap on the taxes at the $10,000. That could change with the law. So it'll be changing from year to year as as those crazy lawmakers doing funny stuff. As they do their funny stuff, these things could change. But here we go. We're going to say it doesn't go over $10,000. And your limit could be different too, because note, you might have state taxes, which could be significant. And so that you have to figure out where your cap will be possibly taken into state taxes. So that the tax calculation, you could add a lot more complexity depending on your current situation. Also, remember, you got to take into consideration if you're not itemizing, you're taking the standard deduction and renting at this point, and then you were to itemize, even if you get this big deduction and the interest, which we'll talk about up here, and you get that full amount as a deduction, as an itemized deduction, you really have to kind of lower that by the difference between the standard deduction and the itemized deduction, because you would have got the standard deduction anyway. So it's a bit complex to get the actual savings amount, run tax software to get a better idea of the deductions and why they're going to be in place. Are you getting capped on the state taxes somehow that's going to limit your deductions? Also remember that the interest here is going to go down even though your payments stay the same, resulting in less tax benefits as time passes with that loan. So take that into consideration as well, which we'll kind of take into consideration here as we go. So we got the property tax. Let's do a formula for this. We're going to say if it goes over 10,000, then we're not going to take it. And if it's under 10,000, then we're going to use this number here. So a fancy if formula, logic formula. If we're going to say if this cell up top is greater than 10,000, then that's a comma. When you say then, comma, then take the 10,000 because that's the cap. But if not, comma, that's where when you say if not, that's where you put the comma. Then you want to take this cell up top. So I think that'll work, and enter, and it should just take that 6,000. If I copy it across, it should be good all the way across. And then at the end, it should just cap us at that 10,000 right there. It worked beautifully. Formula functioning as it should. Let's make this blue and bordered. Another task well accomplished in a quite satisfactory fashion. Let's do the interest payments now. Interest payments on the loan. So the full loan amount isn't deductible. That's not deductible, but the interest portion possibly is. So we're going to say interest portion is up top in our summary data. So we can just copy that across. Notice it will go down. It is substantial for a deduction, but it's going to go down, and it's subject to an itemized deduction, not, you don't get, you got to take that gap between that. So notice it goes down substantially in year 30. You're not getting much of a deduction, even though you're paying the same amount. So those need to be taken into consideration as we think about the long-term investment status here. Blue and bordering this. Let's put the total. This is going to be the total deduction. Total deduction between those two using the trusty sum function. Trusty sum of those two. Copying that across. Summing them up like so. And then let's do the blue and border on that one. Blue and border. Blue and border. Let's put an underline here. That'll indicate that there's a subcalculation. For font's sake, font group. 0 underline. Blue borders. Okay, let's apply the tax. I'm going to use the marginal tax. I'm actually going to show the tax here so we can see it. So I'm going to say the marginal tax. This is our highest tax bracket, not the average, but the margin, because we're making this decision at the margin, as economists say. That's the next decision's consequences, and the consequence now is our highest tax bracket, which we're assuming here 20%. Number group, 20%, or percentizing it. That also needs to be absolutized, F4 keyboard, because it's in column R and not in our table. Copying it across. Copy it across. Copy it across. Let's blue and border, blue and border. Let's blue and border here, blue and border. Let's put an underline under the 20s. Underline for font's sake. And then we're going to say that we have the tax savings. Tax savings are going to be equal to, we get the deduction of the 28,297, we're assuming here, times the tax bracket, which means we only get a savings of the 5,659. Copying that across. Copying that across. There we have it. Blue and borders. Blue and borders. And then we'll blue border this one. Blue and border. Perfecto, just like Mundo would do it. Perfecto like Mundo does it, because Mundo's the perfectionist. Okay, so now let's say we're gonna do the cash flow after taxes. So we can now say, okay, well, what would the cash flow after the tax savings flow for the home purchase after tax savings would be? Just this minus this, right? That's the outflow, and then we got these savings. So I'm gonna take let's do our formatting, dark blue, and then white on the text, years, here's, and 0, tab 1, tab 2, and then we'll select those three, format or take the filled handle and drag it to the right to 30, making this black and white for font's sake. And then we're going to go down and make this black and white. And then we'll just call it the cash flow after tax is just going to be the subtraction, meaning we're going to spend this amount up top, and then we're going to get back or lower our taxes, in essence, an inflow or a decrease in the outflow from taxes of that $5,659, net flow $27,388. Let's copy that across. Copy it across, roger that, roger out, 10-4. And then we're going to say this will be blue and bordered. Then make this blue and border too. Blue and border. Blue and border. So then we can compare that to the cash flow from renting, which is going to be nice and easy. That's what we're currently doing, we're assuming. We're currently renting. And so we're going to say, let's compare that to what I'm currently paying then. I'm going to make that, instead of blue, I'm going to make the renting a different color for the header, making it this dark orangish and white, using the dark and white for the formatting. And this is going to be same thing here, years, 0, tab 1 and 2, tab. And then we'll copy this across, copy that across, copy across, you copy. I copied it, roger out, 10-4, alignment, center, and then we'll make it black and white. And then we'll make this black and white. And we'll say this is the renting cash flow. Renting cash flow. And this will be equal to, we're currently paying, we're saying $24,000, but it's going to go up by 2%. Notice this is going to go up by 2%, whereas the major part of the loan payment was fixed. So we got this difference. We'll have this difference that, the rent will actually go up higher or faster because the whole thing is going up by the 2%. So we'll take the prior cell times 1 plus the 2% increase in the rent that we're saying up top, rental growth rate 2%. That's outside of our table. So F4 on the keyboard, $ before the R and the 4. Close up the brackets, enter, copying that across using the fill handle. Copy it across, please. You copying it, I copy, roger that, and then we're going to say this is going to be blue and bordered, and then we'll blue and border this one, blue and border. Okay, so then we can take the difference between these two cash flows. So we're going to go from here to here, and that's going to be the difference. So if I am currently renting, and then we purchase, putting the down payment up front, the yearly payments after that, that's what the difference in cash flows we're looking at. So we're going to call this the net cash, let's call it cash flow for home purchase. In essence, it's going to be the renting cash flow minus purchase cash flow. Notice this long header I can put up top in this format, which is nice. I'm going to make this a different color because it's going to be blending the blue and the yellowish here, which makes it kind of green, I think, if I know my color blending properly. So there it is. Green and white, and this is going to be the net cash flow, and that's all I want, so 2 spaces. And I'll subtract this out. I'm going to subtract the renting first, the $24,000 minus the $27,388. In other words, if I go from renting where I'm currently paying $24,000, I purchase, put that amount down, 20% down, I still am paying more which is increasing my cash outflow, which I'm going to have as a negative. Actually, let's copy this down. I'm going to take this whole thing, grab it, or you could say control, let's cut it. I think that's easy to see. Cut it, paste it right here, because I want to put my names, the same headers, years. I got ahead of myself because I wanted to explain what's going on. Wanted to explain stuff, but I got to copy this across. We're going to do our same, copy this across. This is going to then be black and white, centered, make this black and white. Okay, so now we still got the outflow, but if I start copying this across, this one, it flips at some point where I'm actually, now I actually have less money going out from the home purchase versus the renting towards the end, right? So here's this is the renting where I'm actually paying less than the home purchase. And then out here, if I was to invest in the home, at some point, my yearly payments are actually less than the renting. So it flips around year 12. Why? Because the rent is going up the whole thing by that 2%. And the home purchase the bulk of it is not going up because we fixed the rate. So a lot of the home purchase, in other words, is in this loan payment, and that's staying the same all the way across. We do have differences in the tax savings and differences in the property and the insurance and whatnot, but this big portion of it is staying the same. So you got that interesting change that could happen. So we're actually still having an outflow that's over and above the renting situation, even though we have the down payment up until year 12. But we also, of course, have to consider the home sale information related to it as well, because the equity going up is part of our big investment. When we think about the equity, we want to take into consideration cash flow as well, making sure that as the equity goes up, we have the sufficient cash flow to do what we need to do in the meantime. So I'm gonna make this blue and bordered. We'll think about the sale of the equity situation next time. So let's stop it here. Let's save it. This just looks excellent. Look at how aesthetically appealing it is on this one. In any case, we'll continue on with it next time.